Welcome to Money News. I'm Kathleen Walter. With us now via Skype is research analyst and trader Stephen Schork. He is the editor of the Energy Insider newsletter, the Schork Report, and the president of the Schork Group. And welcome back to Money News, Stephen.
That's great to be here. Thank you.
A recent Lundberg survey warns that gasoline prices are expected to jump soon as retailers pass along the higher cost of wholesale gasoline to consumers. Gasoline costs $3.59 a gallon on average. How high do you see gasoline prices going, and why are prices spiking now?
Well, right now it all comes down to crude oil, and crude oil over the last month has risen $13 a barrel. General rule of thumb is retail gasoline increases at 2.5 cents a gallon for every $1 rise in crude oil prices. So at this point, with crude oil in the United States trading at about $105 a barrel, we are looking at potentially a 30 to 40 cent increase in gasoline prices prior to the Labor Day holiday. So as you just referenced, with gasoline on a retail level currently around $3.60, the national average could be pushing up towards $4 by the end of this summer driving season.
Stephen, how much is the chaos in Egypt affecting the prices of oil and gas? And are there any other factors in Europe or the Middle East which might also heighten investor fears?
Well, there are three events now driving the rise in energy costs. The first is actually fundamentals. Supply of crude oil in the United States over the last 3 weeks has dropped by a record 27 million barrels. The forward curve in pricing is in a steep backwardation. What this simply means is the market is fearful of an imbalance or a pending imbalance in supply and demand. On the demand side, we have record amount of refinery demand for crude oil. So to recap, we have strong demand and falling supply. The second factor is a reallocation of funds on Wall Street. Investors are pulling their cash out of the natural gas market and putting it into the crude oil market. So as prices have risen, we've seen more money come into the market, and that has indeed given thrust or push to this market and prices higher. And then the third event, as you just referenced, is the situation, the geopolitical situation in Egypt. Keep in mind, Egypt does not produce any crude oil, but a significant amount of Middle East crude oil that comes to the West transits Egypt, either through the Suez pipeline or the Suez. So when you have tight supply fundamentals, money coming in from Wall Street, and a geopolitical headline, you do have the template for higher oil prices.
How high would the per barrel price of crude have to rise to push the average gasoline price to $5 or at least close to it?
For a national average at $5, we would have to see a significant rise, say oil prices upwards of $160, $170 a barrel. I just don't see that happening right now. Current price elasticity of demand here in the United States, as I calculated, is approximately $3.75 on a national average. That is to say, once we get gasoline prices above that level, we do see a turn down in demand. So therefore, we would not get to $5 because quite simply, Americans cannot afford it. They will not afford it. They will not pay for it. And therefore, prices will not go that high.
So you're saying that $5 a gallon is the breaking point for the average U.S. family, the average consumer?
Well, I don't even think it's that high. I think it's more towards that $4 range, keeping in mind that approximately 4% of our household income now goes towards gasoline. If you push gasoline prices up towards $5, then we're looking at potentially 6 or 7% of our dollar going towards gasoline. And that's a big hit to the household budget. And I quite frankly don't think it can get there. Quite frankly, I think, again, that $3.75 range is a key level. Of course, we're going to oscillate around there. I do think at these crude oil prices, we will get that high by the end of the summer. But keep in mind, refinery demand is starting to ebb on a seasonality basis. After Labor Day, there's going to be less discretionary driving in the season. Demand will pull back. So I think this is going to be a short-term rise in price. Not fun for the consumer over the next 6-7 weeks, but there is a light at the end of the tunnel.
Consumer prices rose more than expected in June because of the surging gasoline prices. If consumers are forced to pay more for gas, where do you expect them to cut back? Will they cut back too much out of fear of continued rising prices? And will that hurt the overall economy and stall growth?
Well, I certainly think that is a potential. Keep in mind, every penny that we have to go to pay for gasoline on any increase is a penny that we're taking out of the economy elsewhere. Now, the big change that's occurred in the energy sector over the last 30 years is that in 1980, prices were approximately $1.40. That's $3.50 in today's dollar. But the big difference is in 1980, 6 cents of our household income is going towards gasoline as opposed to 4 cents. However, if we start to push up that percentage going into gasoline, say to 4.5% or maybe 5%, well, that's an entire percentage point being taken out of spending elsewhere in the economy. Of course, in 1981, we weren't going to Starbucks. We weren't paying $2 for a pint of spring water. So we've learned how to spend that money elsewhere. Therefore, if we do take it out of the energy, put it back into the energy sector, it will be taken out of probably discretionary consumer goods.
Is there anything, Stephen, that can be done in the short term to lower prices, such as dipping into the Strategic Petroleum Reserve, or do we just have to ride high prices out?
I think we're just going to have to ride these prices out. Dipping into the Strategic Petroleum Reserve with only about 7 or 8 weeks until the Labor Day holiday is not a feasible, even on a political level. I don't think it's feasible at this point. Keep in mind, the Strategic Petroleum Reserve is designed to address when there is a temporary cutoff in crude oil supplies. It's not meant to temper prices. So therefore, demand is high now. Prices will rise, but again, after the summer, we should see a pullback in price, primarily because not only is demand going to slow down after the Labor Day holiday, but the type of gasoline the industry has to make, a winter grade gasoline, which is cheaper to blend. So just on the prospects of falling demand and cheaper gasoline to manufacture, we should see a break in gasoline prices this September and October.
Last question, Stephen. Does Federal Reserve intervention push oil up on the notion that it thwarts an economic downturn and props up demand, or on the notion that it weakens the dollar and makes oil suddenly attractive in dollar-denominated exchanges?
Indeed, I'm on the second half of that logic. I'm a believer that action by the Federal Reserve as it pertains to the direction of the dollar is steeply correlated to the price of oil prices. There is an inverse relationship. So as the federal government, and look, it's not just this administration, but the administration before that. So over the last 12 years, the United States has pursued a cheap dollar policy. Given that oil prices are priced in those cheap dollars, there is an inherent pop in demand in other currencies. So it certainly does attract investors. So the decisions being made at the Fed do have an impact on prices, to the point now where I'll venture the Federal Reserve has more of an impact on oil prices than OPEC does.
Stephen Schork of the Schork Report, as always, it's good to speak with you. Thanks for being with us today.
Great to be here. Thank you.
And thank you for watching Money News.